Investors are betting on an interest rate cut when Federal Reserve policymakers meet next week. Many consider it an insurance cut to serve as a buffer against potential weakness. And that got us thinking about the impact of such a move. And so we asked Steve Liesman to take a look.
With the Federal Reserve about to cut interest rates at the end of the month, many are asking the question, just what will a quarter-point rate cut accomplish? Fed Chairman Jerome Powell has a list of worries that cutting rates are supposed to address.
We think that uncertainty around trade policy and also global growth, it's not all down to trade policy. There's something going on with growth around the world, particularly around manufacturing and investment and trade.
But some are concerned Fed rate cuts won't address those issues. Companies just got a huge tax cut. Interest rates, they're already low. Skeptics argue if a CEO is worried about the effects of the trade war, a quarter-point rate cut won't prompt any new corporate spending or hiring.
I don't think actually that the cost of borrowing is really a constraint on activity these days. And that's particularly if you're looking at the economy, the real weakness is for businesses. The little guys are hardly having any problems getting access to credit. It's not the cost of borrowing that's an issue. So if you cut rates further, it's hardly going to really boost growth.
And so far, low interest rates haven't helped address the Fed's problem of not hitting its 2% inflation target. Core inflation has remained below target while the Fed maintained an easy policy for a lot of the last 10 years. Inflation has eased just a bit since the Fed began raising rates. Remember, the Fed was still easy, that is, below its neutral interest rate for a lot of the time that it was raising rates. So what would be the upside of a rate cut? Perhaps somewhat lower rates for consumer, home, and auto loans. And by cutting rates, the Fed will bring U.S. rates more in line with the low levels in Europe and Japan.
Since U.S. yields are much higher, the dollar is at roughly a 30-year high on a trade-weighted basis. So I do think you can make an argument that bank lending has slowed, housing has slowed, some of the interest rate-sensitive parts of the economy have slowed. And so whether it's an insurance cut or recalibrating the policy stance, I think you can make a couple different stories to justify cuts.
A rate cut will also show that the Fed is more serious about at least working to hit its 2% inflation target. Maybe most important, a rate cut will avoid a potential sell-off from a market that expects a cut, whether it believes that cut will do any good or not. For Nightly Business Report, I'm Steve Liesman.